Wait, you found a $500,000 problem on a tax return?
Yeah, that's not a minor one. That seems like a rather large one.
I'm so happy to hear that. It really puts my problems in context. Hey, Matt Robison with Mike Morton on the, what is this show called now, Mike?
5 minute finance.
5 Minute Finance. Sounds like a game show announcer should come in and do this. Maybe I should have been a game show announcer. This is the show where we keep things practical, easy, and hopefully in 5 minutes, we give you the information you need to make practical decisions and check things off your to-do list and not worry so much. You know when you should worry, Mike? When you have a $500,000 problem on your tax return. You're using that as a jumping off point today, though, to just give it an overview of how income tax works. Why do you want to do that? Why is that good for people to know?
It's good for people to understand how your income is taxed. I find there's a lot of confusion about, hey, what's income? How is it taxed? I find it's really helpful to understand at a very high level how income taxes work. So therefore, you can start understanding the deductions and how that might impact your taxes. So I really want to give people, because there's a lot of confusion, so I just want to give people a basic understanding of the funnel of how income taxes kind of flow.
Right. We spend so much time on this show talking about, again, practical stuff like I'm going to put money into an IRA, 529, a Roth, a backdoor, and they're all things that go back to my taxes. And it seems like what you're doing is giving people a little bit of a North Star of, well, hold on, back it up for me a second here. What's the process? What's that funnel? Like, I kind of know how much I make, and I kind of know how much the government charges me in taxes. What's going on? And you're just going to give the outline of what that process looks like, that funneling down to from how much you take in to how much you pay.
Yeah, that's exactly right. And the reason the funnel is important, and it's a stepwise process we're about to go through and keep it high level, is also because as you're reading materials, part of this is education. It's a lot of what I do with my clients is there's a lot of jargon in the financial industry, but I want you to be versed when you're reading things like deductions, above the line deductions, credits, and how those fit. I want you to understand where those fit into the funnel. So as you're reading things that may pertain to you, now you have a better sense of where they come
where
in.
It fits in the whole thing. All right. Makes sense. And by the way, programming note, hold on, because as always, we have a listener question. And this one is, muy picante. It's a spicy one. I like it a lot. And we have a one thing segment at the very end. You'll want to hold on for the most practical piece of advice I ever got. It's probably saved me thousands of hours of time over the course of my
Thousands
career.
of hours.
Thousands.
Oh my goodness.
Of hours.
I can't wait.
I don't know. Maybe I should trump this. Millions, literally millions of hours. I don't know how many hours I've been alive, but all right, here we go. So you found this $500,000 problem on a tax return. That's the jumping off. Wait, I'm not sure why you want to start here if you're going to give people a stress-free, like, hey, here's how income tax works. But why start here?
Well, I start here is just kind of an interesting story that I wanted to tell, but also the point of the story is accountants, when you're filing your taxes, you could do it yourself or have an accountant do it, and they can only file what you tell them. So it's really important to gather all the information and supply all of it. And so in this case, I always review tax returns, making sure, whatever we worked on last year is being captured, that it was told to the accountant. And I noticed that there was an account missing. So, you get statements from your accounts, year-end statements with tax information. You forward those on, you input them into TurboTax or forward them on. And in this case, one of those accounts was missing. And this account for my client had a $500,000 capital loss. It had a loss, and this is a couple of years ago when the markets were up and down. And it had a $500,000 loss that was simply not captured in the returns because the whole account was missing. And so we went back, amended the return, and now we have this loss that you can carry forward and offset. And we're going to talk a little bit about capital gains and losses today. But the note here is tell the software or tell your accountant all your accounts, everything that happened is really important because that's what gets filed.
I see. So what you're thinking is by giving people kind of the outline of here's how the broad process works of that funnel, getting from everything you're taking into what you send to the government, it'll help jog for people like, oh, I see where a piece like, hey, here's an account where I lost $500,000, where that fits in and how that can be important. All right, let's do the funnel. Here we go. So what's at the very top?
All right, at the very top of the funnel is your total income. And let me quickly go through just 3 or 4 line items on the tax return, the funnel. I'm going to go through the whole funnel really quick with a couple.
It was like a preview
things.
Of what's coming.
Yeah, this is a preview.
Okay,
yeah, let me give you the preview. Right. Tell them what you're going to tell them, then tell them, and then tell them what you told them, Matt.
Are previews still a thing? Like, I used to go to movies. Wait, are going to movies still a thing? I used to go to movies, and like my favorite part was seeing the previews. Like, do people do that anymore? So
preview. Total income.
Total income.
Total income. Then you're going to calculate adjusted gross income.
Okay, so stepping down in the funnel, so top level, total income.
Total income to adjusted gross income, then to taxable income.
Okay.
Okay, so there's 3 different things. Total income, down the funnel, adjusted gross income to taxable income, and your tax is based on your taxable income. So then you calculate your tax based on that.
So it's like,
and there you go.
3.5 steps. Like
yeah, 3. Yeah,
right.
Exactly.
Okay.
Something like that. Total income, adjusted gross income or AGI, and then taxable income, and you calculate your tax based on your taxable income.
All right. That's actually less complicated than it seems on the surface. All right. So tell me about total income. Wait.
Total income.
Can I guess?
Go ahead, make a guess.
It's the total income.
You got it, man. It's total income from all sources, and not just income, but everywhere that you are potentially making some money. So this would include, capital gains, interest, interest from your bank accounts, dividends from your investment, everywhere that you are gathering money, that you're getting additional money for this year.
Got it.
Even if you don't actually see the dollar, sometimes you don't see them. Like maybe it's in a brokerage account. You don't think about it's like a retirement type of account and it's spitting off interest and dividends. Well, those still count, towards your total income.
Right. So I get tips. I get a paycheck. Yeah. I get investment returns. I get, I find doubloons on the sidewalk as one does.
Yeah, you got side hustle, you get a rental income, you get a rental property.
I'm a sidewalk pirate. Okay. That would be a great name for a rock band. Okay. So that's total income. Let's keep this simple, man. Let's go down. What's
adjusted
next?
Gross income. Next is adjusted gross income, AGI, and you see this word AGI all over the place. And unfortunately, there's a sister term, MAGI, modified AGI, but we're not going to get into that today. So total income is everything from all sources. Then you want to get to your adjusted gross income. All right, and the way that you move down the funnel from total income to AGI is you subtract above the line deductions. So there are some subtractions, taking your total income and you get some subtractions.
Question. I hear this a lot from the accountant and in tax talk. What is the line? Define the line for me.
This is it. AGI is the line.
Oh, I see.
AGI is the line.
Okay.
So to get there from total income, you subtract things like retirement contributions, traditional, you haven't been taxed on them yet. So, your 401k contributions, HSA contributions, so you're not taxed on that. You're not taxed on those traditional contributions. You're not taxed on the HSA contributions. So you get to subtract them. Self-employment deductions are a great one. So people that this is why we're pro small business here in America. So if you have a small business, you could subtract self-employment tax. You can subtract healthcare that your small business pays for you. Student loan interest. There's a bunch of other ones, but those are the major ones. Okay. Mostly, for most people, it's going to be those retirement contributions, HSA, and the self-employment stuff is subtracted to get to your AGI.
So essentially, those above the line deductions that you're doing to get from total income down to AGI, that's kind of affecting the whole pool of income. It's like you're just siphoning out some of that total money that is in your quote unquote income.
That's it.
Okay.
Yeah, that's it.
All right. So now you've siphoned. you've sucked.
So you've taken some of that total income, subtracted some, which is great. Any subtractions are great, okay? Because you're going to get taxed on this. So anything you could subtract is a great idea for you. So now we're at AGI, adjusted gross income.
Okay.
So now we're going to get to taxable income. The next part of the funnel is to get from AGI down to taxable income. And to do that, Matt, since now we're below the line.
So now we're penetrating the line.
Right. So what do you think we're going to do now?
Well, if I'm I don't know, if I'm a linebacker and I'm penetrating the line, I'm going to sack the quarterback. Quarterback is toast.
Below the line, subtracting your below the line deductions.
Below the line deductions, right.
Right. And this is pretty simple. This is what we call the standard deduction or itemized deductions. All right. So you probably heard that. There's a standard and itemized. And we're going to subtract this number from your AGI to get to your taxable income.
Now, I think this is a really important point. Now, I don't want to get too caught on it because, your whole thing here is simple, practical. But I do think the distinction of the standard deduction and itemized deduction is an important one because I personally spend, and I bet a lot of people are like this, I probably spend a lot of my time and effort when I'm organizing my taxes for my tax preparer on things that would go into itemized deductions. And I have this sinking, nauseous feeling. Is that a word, nauseous? Like this terrible feeling of like, I'm wasting my time here because I'm just going to take the standard deduction. Am I right to be nauseous? Like, I mean, yes. I do all these things, but it's so that my tax preparer can say, here's what you would get in the standard deduction. Or here's what, if you itemized all these items, what you would get, and just to compare those two. So am I right that you have to go through this exercise, but a lot of the time it's futile?
That's correct. You got it exactly right. You have to go through it, but a lot of times futile.
Well,
luckily, your accountant's going through most of it. Yeah. Luckily, you're just paying your accountant to do it for you.
Oh, geez. All right. But either way. So the point is, in the process for me as a not smart about taxes person, I've gone through total income and then I've gone down to AGI through some pretty straightforward things like I'm lopping off the retirement, the HSA, self-employment deduction, student loan interest. And now I'm penetrating the line. I'm going down to the third level. And that's where, I have to, maybe I'm using, like one of the tax prep software platforms. It doesn't matter. This is where I'm spending a lot of effort to tally up all those little things to see what can go into those below the line deductions, those potentially itemized deductions. And if that's more than the standard deduction, I'll take that because I want more deductions. But if it's not, then I'll just go with the standard.
Yeah. So here's how it works with your getting from the AGI to the taxable income. You got it exactly right. We're either going to take a standard deduction or an itemized deduction, and we're going to subtract that number to get taxable income. Now, what's the big difference between standard and itemized? Whichever's larger, we want to take. The more deductions, the better, the bigger subtract. So whichever is larger, standard deduction or itemized. The big thing that will push you over the edge is if you have a large mortgage interest payment.
For itemized deductions, you mean?
For itemized deductions. So if you have a large mortgage interest, that might put you over the standard deduction, okay? Now, the one thing I want to note here, because we don't want to get into the details of this, the standard deduction, if you take the standard deduction, your charitable contributions are not helping your tax situation. I run across this a lot as confusion, like, oh, I donated $3,000, that's giving me a good tax break. If you're taking the standard deduction, it's giving you no tax break. So just be aware of that.
It's good for your soul.
It's good for your soul and the organizations, but just be aware because there might be strategies that you could implement in that case. Right. We're not going to get into those today.
No, that's a super important point because again, it's sort of where, I mean, look, I think it goes back to do charitable contributions because you want to do charitable contributions, but don't lean too heavily on it. All right. We should move on because we've gotten to the third level and this is where we get to the half. So we're down now at taxable income. What's the final step?
Yep. So now we're at taxable income, and that is what your tax that you owe, your income tax, is based on. It's based on your taxable income. So to calculate the tax, it's a pretty complicated calculation because your income, remember we started with total income, but that might come from different sources. For a lot of people, the bulk of it's coming from your W-2 or 1099. It's actually hitting your bank account. It's actually your wages. But it could be, for a lot of people, it could be also a lot of interest and dividends. You've got a large portfolio. It could be a lot of interest and dividends or capital gains. So the income's coming from different sources, and they're taxed at different rates. All right. So that's important to know, that your income from your W-2 job might be taxed at a different rate than your capital gains, which is a tax at a different rate than your dividends. All right. And so you have to calculate tax based on where that taxable income is coming from.
I'd like to, just in the interest of keeping this tight and simple and short and bringing things full circle, I want to go back to your story from the top. Where does this, wow, I just found out that I had this loss in this account. Where does that piece fit into these levels? And, like how would the knowledge of it, kind of like where it fits in, sort of help one to remember, like, oh, I see why this is such an important part of the process?
Yeah, capital gains, let's focus in on that. Capital gains get taxed usually at about 15%. But it can go up from there depending on your total income or your taxable income. Actually, based on that AGI. So many things are based on AGI. All right. But normally it's taxed at about 15%. Your ordinary income, okay, just your W-2 job, 1099, that has tax brackets. So the first part is taxed at 10%. Then the next part's taxed at 12. Then the next part's taxed at 15. And it gets progressively taxed at higher rates. That's your ordinary income. But your capital gains are typically taxed at a flat 15%. So if you find a loss, gains and losses are offset. So throughout the year, if you have some gains and losses, you offset those prior to all of these calculations. Okay, so if I have a $15,000 gain, a $15,000 loss, I have no gain because the losses, they offset each other, and I'm not taxed at all. So this $500,000 loss shows up as negative $500,000, and it could offset up to $500,000 of gains. But if we don't have $500,000 of gains, it can carry forward. It does not offset your ordinary income. It only offsets other capital gains, and you can carry it forward indefinitely and offset future gains. So that's, a little bit in the weeds for capital gains, but it's taxed totally differently.
Oh, I see. So, just to recap, we started at the very top, broadest level of the funnel, right? Your jumping off point was the story. And then we got into the funnel, and we started with total income. We went to subtract above the line deductions. We got to our AGI, our adjusted gross income. We penetrated the line. We were the Lawrence Taylor in the next step, and we decided, by tallying up our itemized deductions, are we going to take itemized or standard? And so then we took those deductions. We got to taxable income, and then bringing it back full circle to your story from the top, we have to calculate the tax, and that's where you have to get into all of this ordinary income, investment income. Are there offsets to capital gains? And that's why you need to have that as part of this step. But now I hope people can see, like, this is the overall process that your tax preparer is going through.
Yeah, exactly. And then we got one last final thing. So now you owe 50 grand of tax. Great. We calculated your tax. You owe 50 grand of tax. The final step is credits. So you've heard the word tax credits. And these are great because they're a 1-to-1 offset on that final tax. So I owe 50 grand of tax. Most of it just came out of my paycheck. So maybe I don't, when it comes to April, I don't actually have to write anything. I don't owe anything, but it just came out. 50 grand is what I owed, and I already paid it. Tax credits are a 1-for-1 offset after that 50 grand. So if you got kids, Matt, $2,000 per kid you get to take off. So that 50 grand could be 48, 46, 44. All right. So you're just literally taking it right off of there. Education credits are right off of there. Other ones are clean energy credits, EV credits. The $7,500 for buying a new EV just literally comes off that 50 grand. You subtract $7,500. So credits are really powerful because they're a 1-to-1 offset of the tax that you owe.
Right. So as opposed to like above the line deductions, which are just siphoning out of that big pool of income, that's good. That's really, really good. But it's only affecting a portion of your total tax at the end of the day. These credits are literally taking out dollar for dollar from your tax. So it's a big deal. And that's a distinction between like, oh, I'm going to get a tax break if I itemize and I, let's say, give to charity. Like, oh, I get a portion of that, back. Credits are huge. So the take home is you're telling people to have a lot of kids.
That's right.
Okay.
Yeah, have lots of kids.
Or buy an electric vehicle. They're functionally the same thing. Let me just hint to listeners: kids cost more than a Tesla. A lot more. A lot more. Although there's not an evil overlord behind your kids, unless you're Mike. All right. That is a great overview. I hope that helps people. Now you have like a mental map here. Let's get to our listener question. We have a fascinating listener question today. Like I promised, it was a little spicy, by which I mean someone's taking some shots a little bit at the current administration. We don't do politics on this show, so I'm just going to read it. Here we go. How do we handle this volatile market under the current administration? That's delightfully prim. Well worded, listener.
Well, we are under a current administration, whatever that is, and it's currently a volatile market.
This is
it's just facts.
Great euphemism. We've lost $10,000 in a few weeks, says the listener. And while that's peanuts to some folks, it's really unsettling. How should folks respond? I assume anarchy?
Yeah. You could you leave the country.
Right.
This is, it's a really great question because finally, in the last couple of years, the market's just gone up. It's been chugging along 20% a year for the last 2 years. So we don't get these kinds of questions. When the market's doing well, we don't get these kinds of questions. And it's only when it goes down, it's like, oh my gosh, what's going on? So a few comments. First is take the long-term view and stay the course. All right. Also, in that mindset, separate, we're not going to talk about politics here, but you need to mentally separate kind of politics from economic and financial. Are they interlaced? Oh, of course they are. But your money might be in the stock market, and that's much more about the economy and what the stock market is doing. So stay the course, long-term view. We got decades ahead of us to unfold. The second comment I have here says like, oh, we've lost $10,000 in a few weeks. Remember, you haven't actually lost anything. You only lose money if it was money I was about to spend and I can no longer find it. All right. And I don't have it anymore. Then you've lost money. But if this was money that you've invested for 5, 10, 15 years to spend from 5 or 10 or 15 years from now, then you haven't actually lost anything. All right. So it goes up and down. The third point here, and I think this is the most important, is to recognize that markets will go down. And it's gone, like today, it's down about 7% from the most recent high. So we're not even down to correction yet. We're definitely not down into like a bear market. That's 20%. So get ready because I'm not saying it's coming next month or even this year, but the market will go down. It'll go down 20%. It'll go down 30%. And this is a little taste where we are today of like, how does that feel? Is your investment portfolio prepared? And are you mentally prepared to see the paper value, go down, and then hopefully you stay invested and it, will come back in the future.
Only add on that I would offer is that we did a whole show about whether you can game out and plan for financially what's going to happen in an incoming presidential administration. And the take home from that was you can't. Historically, people have gotten that so wrong. And they've blundered into things that, it's like the George W. Bush administration. There was a lot of discussion about, oh, you should bet on defense. And that did turn out to be true, but it wasn't necessarily a better investment than other sectors. And so there was a lot of scuttlebutt with the incoming administration that we're currently under that, the relaxation of regulations will be good for business and it'll stoke stock returns. But instead, we've seen a lot of volatility because there's been uncertainty about tariffs and the overall economic trajectory that we're going to take. And I think there's a real zen of this, right? We don't know. And so any sense that we have right now that, what we're seeing now is going to continue, it's like, we'll see. We're not sure. Yeah. Could we be living in a black swan? Like, there's going to be a tremendous amount of disruption for years to come. Of course, it's possible. We can't, disclude that possibility. But by and large, history shows that it's really, really hard to predict. So you just got to kind of hang on and white knuckle your way through it.
Yeah, and just, I'm going to reiterate that last point again. Just, you should be ready. Your portfolio will go down by the stocks in your portfolio will go down by 20, 30, 40%. You need to be ready for that, no matter when it happens, mentally, and make sure your investments, are set up for you to fund the future that you need.
All right, let's get to our final one thing segment. And this is one you and I agree on, and I'll kick off the little story here in 30 seconds, which is back when I was a congressional staffer, there is an institution called the Congressional Management Foundation. Are you bored yet? You should be. They don't do a lot, but one thing that they do is they offer all kinds of workplace trainings for congressional staffers. I don't know why just for congressional staffers, because this is great generalized information. And the best one they did was the most boring sounding. How to organize your desk. And the thing is, it wasn't really about that. What it was really about was how do you organize your workflow efficiently and intelligently? And the biggest lesson that they wanted to get across was batch tasks so that everything that passes through your mental transom or your physical spaces, your desk, for example, the papers on your desk, have it cross through your brain just once, not multiple times, because that's where the inefficiency and the loss of time and mental effort comes in. So if you've got emails, say, look, I'm going to answer emails during this set time, and I'm not going to look at the email, halfway do it, and then stop, do something else, and then hopscotch back to the email and do the rest of it, because you're double doing the same mental effort. It's the same thing with papers on your desk. It's the same thing with your to-do list. Batch it so that you're not half-assing a bunch of things. You're using your whole ass on one thing at a time, and you will be much more efficient. You will save, I don't know if thousands of hours was a bit of an overstretch, but you will save a tremendous amount of time and mental effort. You'll be a lot more efficient. And I've continued to use that lesson to this day.
So use your whole ass.
Use your whole ass. That could be the new tagline for this show.
That's right. I was reminded of this exact thing this morning, Matt, where yesterday I did some work for a client and I had to pause about 45 minutes in, and I know I have to come and revisit it this morning. And it took me at least an extra 15 minutes to kind of finish everything up beyond the work. So it would have taken me an hour and a half. It took me almost 2 hours total because I had to revisit, ramp back up, get mentally back in the space. So yeah, visiting things once, put it on the schedule, do it all at once. Get it all the way to the finish line. When you pick a task, get it all the way to the finish line so that you can, not have to think about it or do it again and waste that mental energy.
Speaking of getting to the finish line, we've just done that for this episode. So we're going to jet. We're not going to double do this close. So for Mike Morton, I'm Matt Robison. We'll see you next time.
Thanks, Matt.
Thanks for joining us on Financial Life Planning. If you like what you heard, please subscribe to and rate the podcast on Apple iTunes or Spotify or wherever you get your podcasts. It makes a massive difference. If you have a comment or question, please email me, mike@mortonfa.com. Until next time, thanks for tuning in. This recording is for informational purposes only and should not be considered for investment advice. Opinions expressed are as of the date of recording. Such opinions are subject to change. I cannot guarantee the accuracy or completeness of the data presented here.